Today we're going to have a little game, which is to fire $1,000 per week into the Chinese tech sector. Pa 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 pa. Let's take the enemy down together. You know, Chinese tech has been in bloodshed, declining massively over the last few weeks and months. But today I'll show you my thought process on what I see in the market. In any case, always learn the thought process. Don't copy the actions. Don't, because I mentioned something favorably, jump into conclusions. Fit the strategy to what you want. Fit the amounts to what you're comfortable. Thought process is what you can copy only. And then I also share why now. Because there are trends and things that I see in the market that I believe it is an opportune time to start taking action. And last but not least, I'll share with you this whole game. What does it lead to? Because I'm trying to use this as part of a study for a bigger topic that is very popular. If you're keen to find out, continue watching on. Hi guys, welcome back. Let's start with a big picture context on what has happened on the Chinese tech sector, as well as what some have actually experienced investing in Chinese tech. And let's start with this comment, which is this: $2,000 a month for 100,000, you're going to miss the crash opportunities. Maybe I'll pause a bit there. The context of this is because I shared before, if you are keen, invest very slowly. When markets crash or when a sector crashes, typically it underperforms for a long period. It's not going to rebound based on what I've done in my research. And indeed, with now 4 months into the journey, it's quite true that this is yet another example of crash sites not being real opportunities. And read further. At least 10,000 when the support level is broken. I used to adopt this idea also in global financial crisis. When markets come down 5%, buy, 5% buy. And very soon you realize if you do this, you will deplete whatever ammunition you have very quickly. Because when it drops very drastically. And it cracks through any expectations that you usually have. And the worst part is when it starts to rebound a little bit, you tend to quickly put in more. And that's why having this per block or per level averaging in has a lot of emotional factor to it. So do recognize it. This is probably not a good strategy because emotions make mistakes. Now, having addressed big picture Chinese tech, let's address Alibaba. Alibaba is highly popular. And if you see recent performance operationally for Alibaba, second quarter 2022, you realize that it actually slashed its guidance for earnings, correct? And not only that, they still missed it. So all in all, what we can learn from Alibaba's progress so far in this journey after all these crackdown measures are two things. The first is that stock markets are indeed looking forward. They have forecasted operational underperformance, and right now operational underperformance is catching up to share price underperformance. Same things when the thing is bullish, markets are seeing forward, operations outperform, they deliver more than expectations, you see share price start to surge. So this is the converse, a good learning point. And if you look what happened to SYFE, for example, markets crash, they foresaw SYFE will bleed money, and indeed SYFE showed weak operational performance in the subsequent quarters ahead, right even until now. The second learning point is we never know when recovery is really intact, when more problems will start to surface. So if markets are signaling down, don't have that idea of conviction. You hold on to it blindly. Very often, market is right at certain points. Only at market extremes are they usually wrong. And all this is not helped by the fear that Chinese tech would have to delist at some point in US. Because right now we see TT being forced to delist shortly after doing their IPO 6 months ago only. So this is really spooking the markets. But that leads to the next point where I explain why I'm investing into Chinese tech right now and creating this game for you. Now in this segment, I'll address why now, why I'm creating this 1,000 a week right now only. You know, in previous videos, if you see the thumbnail, it would look as if I'm bullish on Chinese tech after the crash. But if you look at the content within, you understand that I'm sounding warning bells, I'm sounding caution, because what we see in comment sections as well as what most are expecting at that point of time, again in August 2021, is that rebound is going to come very soon. Most were still optimistic and most were thinking it's an opportunity. So the keyword opportunity kept surfacing in multiple comments, and that really signaled to me that market has no pessimism at that point of time. And as I've explained before, markets are not pessimistic at the point of crash. At the point of crash, it attracts a lot of attention from traders. Market is pessimistic when the consensus is fear. That media is not even paying too much attention to any recovery really. That is where market is really pessimistic. And that's the first point for today. This is very unlike what we see in August, whereby we see big investors moving, markets celebrating any potential rebound. And to me, when markets are pessimistic, that is typically when excessive risk is priced in already. And that's why now, when I feel that there is pessimism, why not start something more aggressive, which is 1,000 a week, and fire off at the market. The second is a divergence I see between Chinese tech in terms of their performance. If you look for Alibaba, you realize that it's declined massively, correct? But that cannot be said of JD.com. If you see the difference in performance over the last 1 year, you realize that it's a staggering 50%. What about for a 5-year chart? You realize that Meituan is the best performer. And comparing to Alibaba, it's outperformed significantly also. Tencent seems to have stopped its bleeding also. So that rounds a big point. One company is not doing too well, but the rest seem to have stabilized. And that bodes well, in my opinion, of this market cycle. Again, everything cannot be quantified. It's based on my experience seeing market cycles. This seems to be a point where things are really bottoming out. I'm not saying that it's going to rebound in a week. That's why I'm firing it off on a weekly basis for a year, if you realize. It looks like pessimism is setting in, and that is where risk-reward is favorable. Again, this is different from August. And if you have invested since August, it's been a very painful journey. For the last 4 months, you've seen declines. If you bought Alibaba, decline is quite severe. This decline is coupled with the fact that US big tech is all-time high. Singapore banks are all-time high. So a wrong decision or a FOMO decision, because at that point of time, people are thinking quick rebound, is really a painful lesson. And if you avoid it, that is a good first step. But the next part is how to deploy, because again, markets don't go to zero. And that's why I've adopted this action today to start firing off. Now in this section, I show you my game plan on how I'm firing this 1,000 a week. And in any case, copy the thought process, but not the action. So make sure it's something that you're comfortable with. This is how I'm going to execute it. I'll be using the SYFE Chinese portfolio. And why SYFE? Is because I've done before weekly RSP, weekly dollar cost averaging into the portfolio itself. And how SYFE portfolio works is once you transfer 1,000 in, they'll trigger that by the next working day. So I know the system can work, and that's why I've used this China's portfolio within them to start firing off this $1,000. Any other methods buying ETFs like CQQQ, QUAP, or Lion OCBC HTAG has to be done manually. It can be done, but the overall cost might be even higher because you'll be firing small amounts and there's always brokerage charge. And it also takes effort. So I'm firing this 1,000 for 50 weeks, you see there? And my game plan is this. If we see a 15% appreciation, for example, then we might cut short this 50 weeks. Let it fire off if it's still within that range. Because this period offers a good risk reward, but we also don't know when the real bottom is. So firing 1,000 a week makes sense to me. If it's volatile at the bottom, then let it pick it up on a weekly basis. So if you agree on the strategy, you like this sharing, smash the like button. It helps reinforce that these are popular topics that I can address together with you. And let me show you the big picture on what I'm thinking about. I'm thinking of addressing this question, lump sum or regular investing, which is better? Most research has shown that lump sum works because markets are traditionally up. But right now, we are seeing something that is a sector bet, something that is bearish. So that logic doesn't apply too much. So I'll use this study as part of that big picture topic to create a good content for you in future. So do press on subscribe also and wait for its release. Now how I'm going to do it is I'm going to compare against JP Morgan China Fund, which I already have in my portfolio. How it looks like currently is this. The amounts may be different, but I'm going to keep the amount stable so that we compare on a percentage basis. Make sense? So the weekly firing amount would be aimed at 15%. So how it compares to this fund which I have, which is right now in the red, is that when this turns profitable, it's probably at the 15% mark. Let's see which gets to that 15% mark faster. So I've shared with you my game plan today. Let me know your thoughts and comments in the sections below. And as always, let me invite you to a previous tutorial I've done before on why I've suggested this 2,000 a month dollar cost averaging into Chinese tech then. It was misunderstood, it was taken out of context, but some of the wisdom over there is really aging well with time. And if you are keen to find out, look for that video. I'll leave it over here for you and I'll see you there too. Take care and goodbye.